Hidden costs are likely to destroy even the best thought-out long-term forecast and turn would-be profits into losses. Even if your company sets aside reserves for hidden costs, those costs have an eroding effect. One of the most hidden and most destructive of these is inflation. Many people misunderstand inflation. Some believe that it is caused by rising prices when in fact higher prices are a symptom of inflation, not its cause. The real definition of inflation is the gradual erosion of purchasing power. As the dollar's value falls, it takes more to buy the same amount of goods or services. For example, $1 in 1950 was the equivalent of $7 in the year of 2000. This means that you need $7 in 2000 to buy the $1 worth of goods you could have purchased in 1950. The difference or the loss of the purchasing power comes from inflation over 50 years. The annual or quarterly inflation rate is measured by the Consumer Price Index published by the Bureau of Labor Statistics. The rate is based on the cost of a basket of consumer goods calculated against an index level with a percentage of change each year. Inflation is caused primarily by changes in the money supply. As more money is printed and distributed, its real value declines. Whenever the money supply grows faster than economic growth, normally measured by gross domestic product, inflation rises. Excessive levels of money are printed to fund growing government debt or to improve the credit markets. But over the long term, the effects of inflation create the unavoidable deterioration of purchasing power. For managers, inflation is important not only because it affects purchasing power on both a personal and corporate level, but also because it directly affects all calculations of future cash flow and profits. By definition, the rate of inflation, which is expressed as a percentage of increase in a specified period, month or year for example, is based on the use of an index developed by the Bureau of Labor Statistics. To calculate annual inflation, subtract the change in the annual index and divide the difference by the earlier year's index level. Let's see an example on the spreadsheet. If we enter the current consumer price index for this year and the past consumer price index for the previous year, and here is the formula. Current index minus past index divided by the past consumer price index, and it gives the inflation rate of 19%. From a business manager's perspective, the consequences of inflation are likely to be far different from the consequences for an individual consumer. This difference lies in the way that one set of inflated prices affects overall cost to produce, market and sell goods. For example, the consumer is going to suffer from inflated prices of gasoline and may be less aware that gas prices also affect the cost of food, utilities and even housing. A business manager is likely to be more aware that the overall inflation rate is not equally distributed. As a result, some costs are not as obvious as others. A lending or savings institution with existing contracts on the books for fixed interest income or expense is going to be very sensitive to changes in interest rates. An organization providing non-essential products or services, such as a recreational company, travel or tourism outlet, or hotel chain, will be far more sensitive to the immediate effect of inflation than a company selling necessities. This problem is especially aggravated in times of hyperinflation, when the rate is either out of control or rising rapidly. In calculating a true break-even point, inflation has to be brought into the equation. For managers, the concept of break-even is the identification of the minimum volume of revenues produced to justify an activity. If this forecasting device does not include a factor for inflation, it will be unrealistic, especially for long-term projections. Here is an example. Your company is evaluating a multi-million-dollar investment in a new product line and the initial estimates indicate that if the project is successful, break-even will occur within 5 years. The forecasts include a fixed price and fixed cost assumption and are based on current expense levels. The break-even sales level on an annual basis is summarized on a spreadsheet. Let's see it. Okay, here is the example. We have the revenues of a company, direct costs, which are 58% of the revenues. Here is the formula. Gross profit, which is revenues minus direct costs. Fixed expenses, in this case $6 million. And here is net pre-tax profit, which is gross profit minus expenses. And here is the break-even, which is a percentage, and we find it by dividing net pre-tax profit by the revenue. Okay, this set of assumptions includes a belief that the expense level and the percentage of gross profit will remain unchanged. The product becomes profitable even when the revenue levels rise above this break-even. Here, for example, if revenues were to rise to 30 million per year, here is the picture. We see that break-even rises to 22% without changing any other variables like percentage of direct costs and expenses. They are the same. It's a percentage of revenues. These assumptions could be accurate assuming that no inflation occurs. However, what if the cost of goods sold were to rise? What if expense levels increase substantially? One of the assumptions used is that the product's price would be fixed to remain competitive with better established brands. And here is the example when the estimated 22% return is not going to be accurate if the revenues remain unchanged, $30 million, but if direct costs were to rise by 10%, and here you see it's 68% of the revenues because of the inflation. We find the gross profit as usual, revenues minus direct costs. And the next assumption is that over 10 years and expenses were to rise by 15% from 6 million to 6 million and 9,000 US dollars. In this case, we see that the break-even is 9%. This forecast is less satisfying than the previous assumption of 22%, but it might also be more realistic. Given the altered numbers with inflation assumptions included, this type of exercise should be built into any long-term revenue and profit forecast.